Does this feel familiar? You get thrown into a board meeting, somebody puts up a finance slide with, 3 columns of numbers, and you nod along hoping nobody asks you a direct question. I'm sure you can perfectly explain your product, your market, even your growth metrics and KPIs. All of that. But a balance sheet? Honestly, I get it. Nobody teaches this stuff simply and plain. So today, we're fixing that. In the next 15 minutes or so, you're going to understand exactly what a balance sheet is, how it is structured, and what it is telling you about your business. We'll start from absolute zero. I'll build up the concepts with a very simple example, and then we'll finish by reading a real balance sheet from a company you've definitely heard of. And in case that you're new here, my name is Roland Umlauft. I'm a startup CFO and strategy consultant, and I've spent close to 2 decades working with tech founders and leadership teams in early and growth stage companies. So let's go. First things first, timing. A balance sheet is a snapshot. It shows the state of a business at a single point in time. So, for example, at the end of a quarter, at the end of a year, it is different from a profit and loss statement in that way. Well, a profit and loss statement is looking at a period. Again, a balance sheet is a single point in time. Fundamentally, a balance sheet answers 3 questions. Those are, what does the company own? What does it owe? And what is left over for the owners? So those 3 things are a specific category you'll see on each and every balance sheet in the world. The first of those categories is assets. This is basically everything the company owns or controls. So these are things like cash or computers or buildings. Anything that is owned by the company. The second category is called liabilities. Here we are recording everything the company owes to somebody else. So this could be a bank loan or unpaid supplier bills and so on. And finally, the third category is called equity. This is essentially the difference between the first 2. So imagine if you would have sold every asset of the company and at the same time paid off every liability. Equity is basically what would be left over for the shareholders. This is also called the net worth of a company. And here is the equation that ties it all together. So basically, assets will always equal liabilities plus equity. This equation will always hold every single time, without exception, in every balance sheet, in every company. In the following examples, we will see that every financial event in a company's life will basically keep this equation balanced. Accountants are calling this double entry bookkeeping, but I personally tend to think of it in more practical terms. For example, imagine you get a loan from a bank, so they give you cash. Which means what? You now owe money to the bank. This is an additional liability, but you got an additional asset, cash, with the same value. But I'm getting ahead of myself here. Let's start with a very, very simple example to illustrate these balance sheet dynamics. Let's start a new business. You're 10 years old, it's summer, and you decide to open a lemonade stand. Imagine your mom giving you $100 to get started. That's an investment, not a loan. So she is now a shareholder in your new lemonade empire. Additionally, you borrow $50 from your brother, and he will want this money back at the end of summer. That's what we call a liability. So on day 1, before you've even bought a single lemon, your balance sheet looks like this. On the left side, we have assets. Those are the $150 in cash that you have. On the right side, liabilities, you owe your brother $50. And still on the right side, equity, your mom's $100 investment. $150 on the left, $150 on the right. It balances, and it will always balance. Next, let's do some actual business. So, first, you have to go to the supermarket, and let's imagine you spend $30 on lemons and, other supplies. What has changed? Now you have $120 in cash and $30 in inventory. Your total asset value has stayed exactly the same, but one asset turned into another. Cash turned into lemons that you own. Nothing has happened on the other side. This is a really important concept. Not every transaction changes the size of your balance sheet itself. Some of those transactions will just change the mix of your assets. So buying supplies with cash is a perfect example. Now, the next day, we're going to actually do some business and we're going to sell some lemonade. Business is going well, and let's imagine you sold $70 worth of lemonade on your first day. And this has completely used up your entire stock of supplies that was worth $30. What has happened? You have made $40 of profit. $70 revenue minus $30 supply value. Where does this profit go on your balance sheet? It goes straight into equity. Specifically, this goes into a line called retained earnings. This is the first time you see equity growing, not because somebody invested new money, but because the business actually made money by itself and it is worth more now. Your first day went well, but you realize that you need to buy a proper lemonade cart in order to sell lemonade even faster. You go and buy a lemonade cart for $100, and you're paying $20 in cash from your own pocket, and you're getting an $80 loan from your local bank. The lemonade cart itself is what we would call a fixed asset. Every time you spend money on something, you basically decide how to classify this purchase. This can be an asset or it can be a cost. What is the difference here? An asset is something that remains available to your business for a certain period of time. So like this lemonade stand that you've bought, or even the lemons you buy today for next week's business. Cost, on the other hand, is something that you pay like a salary or your rent. Some assets can and will turn into cost eventually, like the lemons you have in your inventory. They're disappearing from your balance sheet and they turn into cost. Let's buy some additional $50 worth of inventory and then rebuild our balance sheet. First, assets. Cash, after the transaction that we've made, we now have $120 in cash. We also have $50 of supplies, so these are the lemons that we've just bought and other supplies. We have our lemon cart, which is worth $100, which brings us to a total of $270 asset value. On the liability side, what do we have? We have our brother's loan, $50. We have the bank loan of $80, which gives us a total of $130 in liability. And our equity is still mom's original investment of $100 plus $40 of retained earning. So our total equity value is now $140. $130 in liabilities plus $140 in equity equals to $270. Our balance sheet is still balancing. Next, let me show you some additional subcategories in the balance sheet structure. That lemon cart you bought, that's what we call a long-term asset. You're not going to use it up in a month or even 6 months. You're going to have that cart for maybe a couple of years. The lemons, on the other hand, that is inventory, a current asset. Your cash as well. It's a current asset because it is accessible to you at any time. On the liability side, this works very similar. The bank loan, let's say it's a 3-year loan, so it's a long-term liability. On the other hand, the loan from your brother, he wants it back at the end of the summer, so that's what we would call a current term liability or a current liability. This current versus long-term split is one of the more practical things to consider on any balance sheet because this tells you about timing. Imagine a company with 5 million in long-term debt might be totally fine, but compare it to a company with 5 million in current liabilities and only 1 million in cash. That's an imminent liquidity problem. So looking at the structure of long-term assets and long-term liabilities versus short-term assets and short-term liabilities tells you a lot about a company's situation. Now, here's the full anatomy of a real balance sheet. We have assets on the left, and depending on the format you're using, you probably have current assets first, long-term assets later, or the other way around. And liabilities will mirror this. So let's, again, put current liabilities on top and long-term liabilities below. And then finally, we'll have equity at the very bottom, where we have paid-in capital first and then retained earnings that have built up over time. This structure is basically standardized. Whether you're reading a startup's pitch deck or Apple's annual report, this layout will be the same or very, very similar. Okay, now, apart from what we've seen until now, there are a couple more things that usually go onto a balance sheet. And let me show you what those are. Let's start again on the asset side. The first additional type of asset you will usually see on a company's balance sheet are accounts receivables. This is money that your clients owe you. Imagine you sold some lemonade to your neighbor and they promise to pay you next week. That's a classical accounts receivable item. What else are we going to see? Intangible assets. So, for example, from R&D capitalization. This is something that is very common for technology companies. Imagine you employ a team of developers and you're paying their salaries over time, and you ask them to build a website to sell your lemonade, worldwide. Those salaries that you're paying to this team shouldn't just be a cost right away because they are really essentially building a long-term asset for you. So what we typically do is we would put this on the balance sheet instead of directly putting it into cost. And you will see this as an intangible asset. Now, other items you might see are tax assets, for example. So if you're making a loss during a certain year, you can offset this loss against future profits in a future tax bill. So you might see a tax asset on your balance sheet that you can essentially use against your future corporate tax payments. Okay, on the liability side, we also should add a couple of items that we haven't seen so far. First one and most common, accounts payables. This is money that you owe to your suppliers. So imagine you buy lemons, but you don't have to pay your vendor right away. Let's say they give you 30 days to pay after the purchase. On the liability side, we'll also see any other loans you might have, like, an outstanding credit card bill, for example, or unpaid taxes, anything like that. And then finally, something you would typically see in a SaaS business called unearned, prepaid, or deferred revenue. What is that? Imagine somebody gives you $100 today to get a lemonade every week for the next 2 years. When you get these this payment of $100, you actually have not actually sold $100 worth of lemonade yet. You just got a payment for a future service that you have not yet provided. This is essentially what happens when you run a software SaaS company and you have clients paying for a 12-month subscription in advance. You will recognize this revenue bit by bit on a monthly basis as you are delivering your services, and the rest will just sit in unearned revenue on your balance sheet until then. Now, let's take a look at the latest balance sheet of Shopify, and let's see if we can apply what we have learned. So here we're looking at the consolidated balance sheet of Shopify. This is per 31st of December 2025. Now, we're currently looking at the asset side. This is directly pulled from their filings. So we see that in terms of current assets, they have a ton of cash. They have some, liquid securities, etc. And then they have other trade receivables. This is, outstanding payments from their customers. And then there's this line here, which is interesting, which is loans and merchant cash advances. So part of Shopify's business model effectively is reflected here in the balance sheet, with Shopify actually giving money out to their merchants as cash advances, and some other current assets. On the other hand, we have long-term assets. So they have made some investment into other companies, which is basically reflected here in this long-term asset investments, equity, and other investments, and goodwill. And then, as I said, there's some deferred tax assets and some other intangible assets. Next, let's take a look at the liability side. So we see that they have about $1 billion in accounts payable. There's some deferred revenue. This is what we were talking about with respect to them recognizing their revenue according to the period that relates to the service. So if somebody prepays for, let's say, a year of subscription, then the current year's portion would be recognized in deferred revenue and current liabilities, and the next year's portion of that would be recognized in deferred revenue in long-term liabilities. And we also see that there is not a ton of debt here, or hardly any whatsoever. And there's a little bit of lease liabilities and accounts payable. But other than that, there's really nothing going on the liability side. And then finally, we're looking at equity here. So we see that the investors have put something around 10.5 billion US dollars into the company accumulative. And then we are having retained earnings in this balance sheet. They're calling it accumulated surplus, but this is essentially a retained earnings of 2.8 billion US dollars. And this is the accumulated amount over the life of the company. So our total shareholders' equity obviously is composed of what investors have put in plus retained earnings. And this comes to about 13 billion shareholders' equity. And then we have 15.2 roughly billion worth of total liabilities and shareholders' equity, which is exactly matching the amount of assets that they have. Okay, our key takeaways are: Shopify has a ton of cash and current assets, close to 8.3 billion. They additionally have about 6 billion invested in long-term assets, like other companies that they have bought and similar. They hardly have any short-term liabilities or debt. They don't need debt. They have so much liquidity. They're basically financing from their own liquidity. We have seen that the total amount of accumulated or retained earnings is about 2.8 billion over the life of the company. And we have also seen that investors have put a total of approximately 10.4 billion into this business. So this is how you read a balance sheet. If you have found this useful, please hit like and subscribe for more content around startup finance. I will see you in the next video, and I will be talking about the P&L, profit and loss statement.